Look, I'm going to be real with you. Most people handle their paychecks completely backward, and it's costing them thousands of dollars every single year without them even realizing it. Here's the thing. I've been getting messages from people who are making decent money, but they're still living paycheck to paycheck. And when I look at how they're managing their cash flow, I see the same pattern over and over again. They're not broke because they don't earn enough. They're broke because nobody ever taught them the correct sequence for allocating money. So today, I'm walking you through the exact priority system I use for every dollar that comes into my account. And here's what most people don't realize. The order matters just as much as the amounts. Get the sequence wrong, and you'll be working twice as hard for half the results. Now, before we dive in, I need to address something. Everything costs more than it did 3 years ago. I'm talking 25 to 30% increases on basic necessities. Interest rates have been fluctuating like crazy. The financial landscape has completely shifted. So if you watched a similar video back in 2023, understand that the game has changed. The contribution limits have increased. The interest rate environment is different, and honestly, the stakes are higher than ever. All right, let's get into it. Priority number 1. Cover your non-negotiables. The very first thing your money needs to do is keep you from financial disaster. I'm talking about minimum payments on any debt you have. Credit cards, student loans, car payments, those buy now pay later schemes that seem harmless until they're not. Here's why this comes first. Miss one payment, just one, and you're triggering a domino effect that can take years to recover from. Your credit score tanks. And once your credit score drops, suddenly you're paying higher interest rates on everything. That apartment you wanted to rent? They're going to deny your application or demand a bigger deposit. That mortgage you're trying to qualify for. You're looking at an extra half point or full point on your interest rate, which translates to tens of thousands of dollars over the life of the loan. Let me give you some perspective here. Your credit score is built on 5 factors, but 2 of them account for 65% of your entire score. The biggest one? Payment history. It's worth 35% all by itself. The second biggest? Credit utilization, which is 30%. What this means is simple. Make your payments on time and don't max out your credit cards. Do just those 2 things consistently, and your credit score will naturally take care of itself. Now, in this step, you don't need some elaborate debt payoff strategy yet. We'll get to that later. Right now, you just need to make sure you're not shooting yourself in the foot by missing payments. Set up auto-pay for the minimums. Remove the possibility of human error. Done. Priority number 1.5. Remove yourself from the equation. Okay, this is the hack that nobody talks about, but it's going to make everything else in this system 10 times easier. Automate everything. Here's what most people don't realize. Willpower is a finite resource. You know what happens when you rely on discipline to move money around every single month? You forget. You get busy. You convince yourself you'll do it next week. And then suddenly 3 months have passed and you haven't contributed anything to your savings or investments. But here's the psychological trick that actually works. You can't spend money you never see. If the money automatically transfers out of your checking account the day after your paycheck hits, you never get the chance to rationalize spending it. The decision is made before temptation even enters the picture. Most banks and investment platforms let you schedule recurring transfers. I'm talking about a 15-minute setup that will save you literally thousands of hours of mental energy over your lifetime. After you finish this video, go into your accounts and automate everything we're about to discuss. Set it and forget it. This is the closest thing to financial magic that exists. Before we move on, comment down your personal financial magic. It could be a habit, a mindset, or a small rule that's helped you save, earn, or spend smarter. Your tip might be the one someone else needs today. Priority number 2, fund your operating system. Next up, you need to make sure you've got enough cash to cover your monthly operating expenses. Think of this as your financial runway. The money you need to live your normal life without stress. I'm talking about rent or mortgage, groceries, utilities, transportation, insurance, cell phone, internet, all that stuff. The non-negotiables of daily existence. Here's a practical example. Let's say your monthly essentials look like this. $1,850 for rent, $320 for utilities, $400 for groceries, $250 for car insurance and gas, $180 for your phone and internet. That's $3,000 per month just to keep the lights on and food in your fridge. Now you might be thinking, okay, so I just keep $3,000 in my checking account? Not quite. I actually recommend keeping a little cushion above that, maybe $3,400 to $3,600. Why? Because life doesn't care about your budget. Your car needs an oil change. You run out of laundry detergent. Your friend's birthday pops up. Those little irregularities add up fast, and that buffer prevents you from dipping into the wrong accounts. Here's where it gets really interesting. This operating money is not your emergency fund. A lot of people confuse these two things. Your monthly operating budget is for predictable, recurring expenses. Your emergency fund, which we'll talk about next, is for the unpredictable stuff. Totally different purposes, totally different buckets. Now, you've probably heard of the 50-30-20 rule. That's 50% of your income to needs, 30% to wants, and 20% to savings and investments. It's a decent framework. But here's the reality check. If you live in New York City, San Francisco, Boston, or basically any major metro area, your needs might be closer to 60% of your income. On the flip side, if you're in a lower cost of living area, maybe you're closer to 40%. The point is this: run your own numbers. Don't just copy someone else's percentages and hope it works. Pull up your bank statements from the last 3 months, categorize your spending, and figure out your personal baseline. Because if you don't know where your money is actually going, you're flying blind. Priority number 3, build your financial shock absorber. All right, here's where a lot of people get stuck. The emergency fund. Here's the thing about emergencies. They don't schedule appointments. Your car doesn't check your calendar before the transmission fails. Your landlord doesn't ask permission before raising your rent. Your employer doesn't give you 6 months' notice before a round of layoffs. A few years ago, conventional wisdom was to have 3 months of living expenses saved up. But look, we've seen more economic volatility in the past 3 years than we did in the previous decade. We've seen inflation spikes, mass layoffs in industries that were supposed to be recession-proof, and entire sectors getting disrupted by AI. So here's my updated recommendation for 2026. Aim for 4 to 6 months of expenses. I know that sounds like a lot. If your monthly needs are $2,800, we're talking about $11,200 to $16,800 sitting in an account you're not supposed to touch. That's a significant chunk of change. But let me ask you this. What's the alternative? Not having it? Because I can tell you exactly what happens when you don't have an emergency fund. You get hit with an unexpected $2,000 expense, and suddenly you're putting it on a credit card at 24% interest. That $2,000 problem just became a $2,500 problem, and it's compounding every month. You can't pay it off. Now, you might be thinking, there's no way I can save $15,000 right now. I get it. So here's what you do. Set a milestone goal. Get to $5,000 first, then $8,000, then $12,000. Make it feel achievable instead of impossible. In terms of where to park this money, you want it in a high-yield savings account. This is money that needs to be accessible immediately, but should still be earning something while it sits there. Now here's the frustrating part. Back in 2023 and 2024, high-yield savings accounts were paying between 4% and 5%. Those were good days. These days, you're looking at somewhere between 3% and 3.5%, depending on which bank you're using. That's still dramatically better than a regular savings account, which averages about 0.11%. But let's be honest, it's not what it used to be. As interest rates continue to fluctuate over the next few years, we might need to get creative with where we park our emergency funds. But for right now, a high-yield savings account is still your best bet. Priority number 4. Lock in your future. Once you've got those first 3 priorities covered, now it's time to start building wealth. And the single best place to start is with your employer's retirement plan. In the US, that's usually a 401k. In the UK, it's a workplace pension. Australia has superannuation. Canada has RRSPs. Whatever your country calls it, the principle is the same. This is tax-advantaged money designed to grow for decades. Here's what most people don't realize about retirement accounts. The real power isn't just the tax advantages, it's the compounding effect over time. And the earlier you start, the more absurd the numbers get. Let me show you what I mean. Let's say you're 25 years old and you start contributing 10% of a $75,000 salary to your 401k. That's $7,500 per year. You invested in a low-cost S&P 500 index fund that historically averages about 8% annually. You keep doing this consistently for 40 years until you're 65. How much do you think you'd have? Take a guess. The answer is approximately $2.1 million from just $7,500 a year. That's the power of time and compound growth working in your favor. Now, here's the kicker for 2026. Contribution limits have gone up. If you're under 50, you can now contribute up to $24,500 per year. If you're 50 or older, that jumps to $32,500 with the catch-up contributions. But here's the non-negotiable. If your employer offers a match, you need to contribute at least enough to get the full match. This is free money. If your employer says they'll match 5% and you only contribute 3%, you're literally leaving money on the table. It's like turning down a raise. Beyond the match, how much you contribute is up to you. My recommendation? Aim for at least 10 to 15% of your paycheck going toward retirement. Some people will say that's too aggressive. But here's the reality. Social Security isn't going to be enough to maintain your lifestyle in retirement. You need to be building your own financial foundation. Now, the downside of retirement accounts is liquidity. This money is locked up until you're 59 and a half. If you try to pull it out early, you're hit with penalties and taxes. For some people, especially younger people, that feels constraining. But that's actually a feature, not a bug. It forces you to leave the money alone and let it grow. Priority number 5, eliminate the expensive debt. All right, now we're getting into debt strategy. And this is where a lot of financial advice gets confusing because there are different philosophies here. First, let me define what I mean by high-interest debt. Anything above 15% is high interest in my book. Credit cards, payday loans, certain personal loans, these are the financial anchors dragging you down. There are two main approaches to paying off debt: the avalanche method and the snowball method. The avalanche method says pay off the highest interest rate first. It's the most mathematically optimal approach. Let me give you an example. Let's say you have 3 debts. A car loan at 7% interest with a $3,000 balance, a credit card at 24% interest with a $3,000 balance, and student loans at 4% interest with a $3,000 balance. Which one should you attack first? The credit card, no question. That 24% interest rate is eating you alive every single month. So you pay the minimums on the car loan and student loans, and you throw every extra dollar at that credit card until it's gone. Then you move to the car loan, then finally the student loans. The snowball method takes a different approach. It says pay off the smallest balance first, regardless of interest rate. The idea here is psychological momentum. You knock out that small debt, you get a win, you feel good, and that motivates you to keep going. Which method is better? Honestly, it depends on your personality. The avalanche method will save you more money in interest over time. But the snowball method might keep you motivated longer if you need those psychological wins. Now, here's where it gets interesting. What about lower interest debt? Should you pay that off, or should you invest? This is one of the most common questions I get, and the answer is, it depends. If you have student loans at 4% interest, mathematically it makes more sense to invest that money instead of paying extra on the loans. Why? Because historically the stock market returns about 8 to 10% per year. So you're potentially earning 8% on your investments, while only paying 4% on your debt. The math works in your favor. But, and this is important, math isn't everything. There's a psychological component to debt. Some people hate carrying debt, even low-interest debt. And you know what? That's valid. If paying off that 4% student loan gives you peace of mind, if it lets you sleep better at night, then do it. Because the best financial decision is the one you can actually stick with long-term. Priority number 6, build wealth beyond retirement. Once you've covered steps 1 through 5, now we're in wealth building mode. Here's my personal priority sequence. First, contribute enough to your 401k to get the full employer match. Then, max out your Roth IRA. Then, if you still have money left over, Either top up your 401k or open a taxable brokerage account. Let me explain why the Roth IRA is so powerful. With a Roth IRA, you're contributing after-tax dollars. You've already paid taxes on this money. But here's the magic. All the growth is completely tax-free. When you retire and start pulling money out, you don't pay a single penny in taxes on any of the earnings. Let me give you an example of what that means. Let's say you contribute $7,500 per year to your Roth IRA starting at age 25. By the time you're 65, assuming 8% average annual returns, you'd have about $2 million. And when you withdraw that money in retirement, zero taxes owed. You get to keep all of it. For 2026, if you're under 50, you can contribute up to $7,500 per year to a Roth IRA. If you're over 50, you get catch-up contributions, so you can put in up to $8,600. Now, once you've maxed out your Roth IRA, if you want to invest even more, you have two options. Either max out your 401k completely or open a taxable brokerage account. A taxable brokerage account is just regular investing. No special tax treatment, no contribution limits, and you can access your money anytime without penalties. The trade-off? You pay taxes on your gains. Here's how it works. Let's say you buy stock in a company, and it goes up by $10,000. If you sell within the same year, that gain is taxed as ordinary income, which could be as high as 37% depending on your tax bracket. But if you hold that stock for more than a year before selling, it qualifies for long-term capital gains, and you'll pay somewhere between 0% and 20%, depending on your income level. So here's my strategic approach. In my Roth IRA, where growth is tax-free, I go for higher risk, higher reward investments. Growth stocks, emerging market ETFs, sector-specific funds. I want maximum upside in that account because I'll never pay taxes on the gains. In my taxable brokerage account, I stick with simple tax-efficient index funds. The S&P 500 total market index funds, maybe some dividend aristocrats. These investments are reliable, have low turnover, and won't generate a massive tax bill. But here's the thing. Don't get so caught up in optimizing every decision that you never actually start. Consistency beats optimization every single time. Investing $500 per month in a simple index fund will destroy trying to find the perfect investment and never actually doing anything. Priority number 7, build multiple money streams. All right, if you've made it this far in the system, congratulations. Seriously, you're already doing better than most people. You've got your bases covered, you're investing consistently, and you're building wealth. But here's where it gets really interesting. This is where you start diversifying how you make money, not just how you invest it. Here's a stat that should wake you up. According to research, 65% of self-made millionaires have at least 3 streams of income. 3, not 1, not 2, 3. And look, in 2026, relying on a single income source is honestly kind of risky. We've seen massive layoffs in tech. We're watching AI reshape entire industries practically overnight. Economic uncertainty is basically the baseline now, not the exception. Now you might be thinking, I don't have time for a side hustle. I'm already working 40 to 50 hours a week. I get it. But here's the thing. You don't need to work 80 hours a week to build additional income. What if you dedicated just 3 to 5 hours per week? Just a few hours on the weekend, or a couple hours in the evening. Let's say those 5 hours a week generate an extra $500 per month. That's $6,000 per year. Over 10 years, if you invest that money at 8% returns, that's over $90,000 from 5 hours a week. So what are your options? Let me throw out some ideas. Freelancing in your area of expertise. If you're good at graphic design, writing, coding, consulting, there are people who will pay you for those skills. Dividend-paying stocks. This is passive income that requires an upfront investment, but can generate cash flow for decades. Content creation. YouTube, TikTok, Instagram, a newsletter. Build an audience around something you're knowledgeable about or passionate about. Online business or e-commerce. Print on demand, Etsy shops, digital products. The barriers to entry have never been lower. Teachings or coaching. If you're great at something, there are people who want to learn it from you. Real estate or REITs. Whether you're buying rental properties or investing in real estate investment trusts, this can be another income stream. Here's what makes this so powerful. Any extra money you make from these income streams can be immediately funneled back into priorities 1 through 6. Bigger emergency fund, more investment contributions, faster debt payoff. It all compounds. The bottom line. Look, managing money isn't complicated, but it does require intentionality. Most people fail not because they don't earn enough, but because they never create a system. They're making financial decisions reactively instead of proactively. This priority system works because it's based on both math and psychology. It protects you from disaster first, then builds your foundation, and finally focuses on wealth creation. The sequence matters because each step makes the next step easier. So here's what I want you to do after watching this video. Don't just consume this information and move on. Actually implement it. Go into your bank accounts and set up those automatic transfers. Calculate your monthly operating budget. Figure out your emergency fund target. Start contributing to your retirement accounts. The gap between knowing and doing is where most people lose. Don't be most people. If you got value out of this video, subscribe to the channel because I'm breaking down money concepts like this every single week. And if you want to learn more about actually investing your money, the specific investments, the strategies, the platforms, I've got a complete beginner's guide that I'll link in the description. Thanks for watching. Now go take action on this stuff. I'll see you in the next one.